I wanted to thank everyone for coming. I'm Gary Simpson, the Dean of the Law School. I wanted to welcome you to the Battisti Memorial Lecture. This is the 12th annual one. The Law School is very proud to be sponsoring this. It was established in 1995 in honor of Judge Battisti of the District Court of the Northern District of Ohio, and substantively, this lectureship is really a very important part of our academic program here, and I'm really delighted so many of you came. Before we start, I just wanted to welcome the family of the late judge, especially Mrs. Gloria Battisti, the Honorable Diane Karpinski, and Mercedes Spots. Thank you all very much for coming. If you wouldn't mind standing to be recognized. I also wanted to thank the Honorable Marilyn Shea Stoneham and Dennis Therese, who was a former law clerk of Judge Battisti. They put in a great deal of time helping to organize tonight's event. We really appreciate it, and we would like to recognize as well the various distinguished members of the judiciary here. I understand that a number of the judge's law clerks are also here. If you would stand. In establishing this lecture, the judge's law clerks and his family wanted to encourage examining various areas in which the judge made special contributions. And this is really a wide range of different areas: civil rights, the role of an independent judiciary, the administration of justice, the art of judging, relationship between religion, morality, and the law, and legal history. Judge Battisti was on the District Court for the Northern District of Ohio for 33 years until 1994, probably best remembered for his rulings in Cleveland's school desegregation case and for his expansive approach to civil rights. Dr. Manning, who I'll introduce in a minute, is the 12th speaker to address the Case Western community under the auspices of this endowed lecture. He follows a long line of very distinguished speakers, including Judge Weinstein from the Eastern District of New York, who is well known for all the class action litigation he's handled, Judge Leon Higginbotham, who I believe was the first African American on any federal court of appeals, then Lee Bollinger, who was dean at Michigan Law School, then president at Michigan, now president at Columbia University, Kurt Schmoke, who was the mayor of Baltimore, now Howard University School of Law dean, Erwin Chemerinsky, most recently, who you could not help but see in various newscasts. He's at Duke University, a tremendous litigator as well as constitutional law professor. I'd like to introduce now our lecturer for 2007, Dr. Robert Manning, the research professor, director of the Center for Consumer Financial Services at Rochester Institute of Technology. The title of his lecture is After the Financial Services Revolution, Banking, Deregulation, Bankruptcy Reform, and the Consumer Debt Crisis. He's a specialist in the deregulation of retail banking, consumer finance, comparative economic development, immigration, and globalization. Among his publications is the widely acclaimed book, Credit Card Nation, America's Dangerous Addiction to Credit, which came out in 2000. His study, Credit Cards on Campus, was published by Consumer Federation of America in 1999, and that has led to numerous federal and state legislative initiatives, including the College Student Credit Card Protection Act, which received bipartisan support in the U.S. Congress. His research has influenced public policy debate on the statutory regulation of retail banking and consumer debt in the United States and other countries, including Canada, Great Britain, Greece, Korea, and Australia. He was a senior Fulbright lecturer to Mexico, a frequently invited expert before the U.S. congressional committees, The list of his accomplishments really can go on and on. I encourage you both to look at the program and to look at his website for more details. Some of you, I assume, had the opportunity to see the screening of the movie earlier today, In Debt We Trust. It's a documentary based on his research and was just released in the fall of 2004. So I wanted to ask Dr. Manning to come up. We had a token of our appreciation to give him before his lecture, and then we will open it up for his lecture.
Thank you for coming. My pleasure. Thank you. I can't tell you what a pleasure it is to be here because of the logistical challenges that I faced today. So I had a choice of making sure my computer came with me or my suit. I know where one is, and I think that we're all better for that. And I do want to say how pleased I am and flattered that I'm been invited here to honor the work and the memory and legacy of Judge Battisti. And just by seeing so many of his law clerks and family members coming here, I realize what a special event it is and what an honor it is for me to present some of my work that I feel will serve within that tradition of his activist work on the bench. I'm kind of a little bit unique in this regard as a academic outside the court who has recently had the good fortune of serving on some fairly high-profile suits, and some of them dealing with federal preemption that I want to share with you kind of at the end of my talk. So a couple of weeks ago, I testified at the Senate Banking Committee hearing, and I wanted to present what I saw as really the crisis in American society in terms of a tremendous shift, not only a cultural shift as well as a statutory shift, but also a major, profound historical change in terms of what could have implications not only to the future standard of living of America, but our role in the global economy. And in particular, I know that a lot of the national media started to question some of the figures and the statistics that we throw out, and particularly as we discuss bankruptcy reform. And I've been working in Washington, D.C. now for almost 25 years, and I've been struck at how little importance the facts mean today. In fact, it's really a tragedy to say in the Rovian world of Washington, D.C., but if you say something enough times, it does become the truth. And many of you who have studied the bankruptcy reform process have heard many figures thrown out that became fact. And so one of the things that I wanted to do today is to give you a little kind of, bring you in easy, a little cultural romp on what has been, I would say, one of the major cultural revolutions in American society that created the receptivity for what I saw as one of the major changes in terms of the American economy and society, and that was the shift through globalization of America becoming a manufacturing to a consumer-based post-industrial economy. And within that framework, what I wanted to present when we look at the discussion of the issue of consumer debt and bankruptcy reform is we're going to see many extreme positions, particularly there's going to be an advocacy movement coming out this spring about fair lending, and you're going to see more of a backlash and retrenchment of the banks that are saying, of course, it's an individual problem and that the problem can only be addressed in terms of people taking personal responsibility. And so what I want to do is say that, as in most cases, there needs to be some kind of middle ground that's going to be sought, one in terms of institutional frameworks of responsible corporate behavior, and the other in turn asking the question about why there's been such a profound shift and what does it really mean to American society that debt capacity has been dramatically transformed. And more importantly, what are the implications it's going to have for us as a society? I will argue that our dependence on cheap credit may have as profound a foreign policy implications as our dependence on cheap petroleum, with equally significant foreign policy ramifications. So with that being said, I could see that 16 tons was a winner. So let let me just start off with why I think we need to understand the cultural revolution that's occurred in American society, to begin to understand the receptivity and resistance to what has been a tremendously rapid change in terms of the deregulation of the financial services industry. Look at what that's meant then in terms of just in the last 10 years, how and why we've seen a doubling of consumer debt. And I'm going to discuss why this is a vastly underestimated problem, both empirically as well as in the discussion of the frameworks of analysis. And then I want to conclude with the future of these kinds of banking reform issues and where the consumer is today and what are the major issues dealing that, unfortunately, from my perspective, what has been limited by the nature of the federal supervision of the banking system through federal preemption is that we're really going to have to rely more and more on case law issues and class action litigation, and this certainly plays into the issue of tort reform. And I'm going to try to combine with you, particularly I think an important case that shows how dramatic the profound change in financial services emerged through the emergence of securitization and the rise of asset-backed securities, and how this is now essentially allowed the train to leave the station at such a rapid pace that the other supervisory framework of understanding what the implications of securitization are means that we're seeing more and more of a loss of consumer rights, but also more and more stress on the American financial system. So, cash is an interesting cultural and generational discussion point. And it's been very intriguing to me doing some presentations to regional banker associations when I talk about bankruptcy law, because I can tell right away that if somebody's over 50 or 55 in the banking industry, they're going to say, put those people in stocks, make them pay every penny. We're not going to consider any time of relief for a debtor. And then I look at bankers under about 45, and they're like, wow, we got to keep this system going. We got to keep people in. We got to figure out how to get debt relief. Complete generational divide. Again, raising the issue in terms of this dialogue generationally. What really has changed? Has it been a revolution? And I would argue, indeed, as we look at what's happened in deregulation, and one of the theses of my book is that credit cards were essentially the battering ram that led to the erosion and dismantling of some major statutory Depression-era regulations, such as interstate banking restrictions and Glass-Steagall. So historically, who could not remember the kind of Puritan economic moralism of Benjamin Franklin, the old school attitudes of a penny saved is a penny earned? And there were two important issues here as we talk about the future of Americans' financial planning. Ben Franklin emphasized that it's not the big gaping hole that sinks the ship, it's the multitude of the little leaks that collectively sink the ship. And that basically people need to understand where every little penny of their resources go. But also, if you're a saver rather than a debtor, you're actually going to be able to accumulate wealth and have passive income. So there are two very important issues here. Now, when I was publishing my book, not surprisingly, the credit card industry rejected every single request I had for a visual or a graphic in the book. And the only thing I could find was this 1860s lithograph, which of course was no longer under copyright law. And it really set the tone, I think, as we begin to ask these kinds of questions of how much have things changed. What you can't see right here in the lithograph is there's an arrow. It says, this way to the poorhouse. In other words, the merchant who did it the old way gave credit and was going to go out of business in 1860. The opulent, successful merchant was one who only worked on a cash-only basis. That's what success would be in the early industrial era of American society. As we met, as I played here real briefly for those who weren't here, if it still works. Very important stanza that you probably
Some people say a man is made out of mud. A poor man's made out of muscle and blood. Muscle and blood and skin and bones. A mind that's weak and a back that's strong. You load 16 tons. What do you get? Another day older and deeper in debt. The same people Peter, don't you call me 'cause I can't go. I owe my soul to the company store.
What most people tend to forget is the role of religion in social control and expenditures. And the whole issue here, particularly in certain more conservative Protestant sects, was that one way of demonstrating one's worthiness for salvation before God was to demonstrate one's ability to resist temptation of materialism in this world. And this is a very important stanza here when he says, St. Peter, don't you call me, because I can't go. I owe my soul to the company store. He still has a debt. Well, how many Americans do you think going to the pearly gates today would have that anxiety if they actually owed somebody money that they couldn't go to heaven? This is, of course, the company store script, where we had many multiple forms of currency that were emerging in the early 18th and 19th century. In fact, of course, we still accepted Spanish currency until 1857. Company stores were, of course, very important because a debt was a form of social control. It limited competition in labor markets. If you were paid in script, you couldn't bring currency, which means you couldn't leave that particular company and seek another labor market that would offer you a more advantageous employment. What I find so crucial in understanding how rapid this change has been was to look at the games that we have our children play. And so, for those of you, certainly we all know what Monopoly, and it emerged during the Great Depression, but there were many variations of Monopoly. And in fact, the earliest versions was a very strong critique about the rise of American capitalism, and it was to present a cautionary tale about the lack of opportunity for the working class in American society. But the irony, of course, was that they couldn't sell the game for a couple of years, and eventually Parker's brother did take on the game, and it's become the most successful board game in the world, and it's used by the most successful franchisee company in the world, McDonald's, with these ubiquitous games that kids play about Monopoly. But do they really get the message? Because what's the goal of Monopoly? What kind of values are inculcated in children? It's long-term planning. Money is to be invested. If you actually play by the rules of the game, you have to pay interest when you borrow money. And what happens? How do we know when you've lost this game? What do you do? You have to publicly explain and declare to the world that you're bankrupt. The social stigma and shame of being financially insolvent was inculcated through these early games. Interestingly, as we talk about the difference about how we finance the war and civic involvement and civic engagement, during World War II, especially for younger people, before you could afford war bonds for children, there were actually war stamps. And you would save your pennies and buy stamps. And you actually would see a lot of these patriotic images that for the civilians at home, their contribution was not only sacrificing and increasing the national savings rate, but putting that money into war stamps and war bonds. Indeed, this iconic image on Iwo Jima about the success of America during the war was the central issue was the civilians at home were still doing their contribution by saving and buying war bonds to make sure that the soldiers abroad, men and women, both were adequately equipped to maintain the war effort. Now, as I jumped to that, I was looking at some interesting ways in which credit cards became part of this process. And I like to look at this particular example about looking at credit cards as a way of hopping over these interstate boundaries and walls. Indeed, in World War II, of course, there were no universal credit cards. There were lines of credit, informal lines of credit to merchants. Montgomery Ward's and Sears, they offered lines of credit and proprietary credit cards, but they actually lost money on those programs. And we tend to forget that today. I like to use the Rolling Stones then as kind of the epitome of a that kind of of wisdom from Nick and the boys, but the real point is that this was a transition from the society of scarcity, where families were basically operating to provide needs that were prioritized over wants and desires. And as we get to World War II and the rising standard of living, we now transition with the emergence of a consumer society, where now we've gone from the society of scarcity to the society of abundance. And now we're going to see patriotic consumption being the driver of American society. So I wanted to use the Ben Franklin presentation as a juxtaposition of how these key important images, icons in American society, promoting conservative financial behavior, were actually used in the new school values of marketing consumer credit and debt. And this is actually a major marketing campaign by the Smithsonian Institution, one of the key campaigns, strategies of the credit card industry, where accumulating debt was perceived as a personal weakness and a social shame. And so how does the credit card industry invoke people to spend where it's viewed as a positive way? And this is a twofold strategy that we have here. First, associating it and co-branding the credit card with the Smithsonian meant that a portion of your purchases went to this preeminent institution of American society. On the other hand, notice this interesting twist. A penny saved is a penny earned, but now a penny spent can earn you a free savings bond. Now, Ben Franklin would roll over in his grave if he knew that his advice was being used to encourage people to spend to earn something for free. And it's a very important cognitive transition that's being made as we see the marketing of consumer credit in the future. Another striking example that emerged in the same period of time was the U.S. Treasury Department selling savings bonds over the internet, which meant, of course, you had to purchase them with credit cards, and 3 out of 5 households have credit card debt, which means you're paying 20% for a bond in present value, in this case worth about $27, and with a yield of under 5%. I mean, some incredible confusion is going on here about how we're reshaping what's socially acceptable forms of consumption. I wanted to use this example from Caesar's Palace of efforts to show that the society of abundance has always been here, that there hasn't been a real need to contain and constrain one's consumptive behavior, that we can go back into history, and the indolent behavior of the Romans gave us a starting point, that all societies have a historical continuity of spending and shop us till they drop us. In invoking other important early historical influences, this Future of Money campaign, using the credit card to develop George Washington's image, again, this was very important subliminal messages that the credit card industry was trying to say, that the future of money is we're going to go from the cash society to checks, to electronic transactions, etc., beginning with our founding father here, encouraging us to basically move on with the program. The key point being, once you're involved in the credit transactional system, it's like getting people to go to the mall. Once they're there, they'll go shopping and they'll buy things. Once people start using credit, they will eventually have an event that will drive them into consumer debt. Now, just as I was looking at games, I was looking at movies. This was the first movie I could find that dealt with credit cards, and it was called Funny Money in 1978. And this was an interesting twist because very few middle-class Americans were qualifying for significant lines of consumer credit on credit cards. Credit cards were offered strictly as a loss leader to cement consumer loyalty within the retail banking industry. They were willing to give you a credit card for only the best customers. And so in this movie, average Americans didn't quite have access to credit cards, and they were very confused, and they thought it was a very privileged item, and that all you had to do was get a credit card and you could magically buy anything you wanted. You didn't have to pay for it. The cult classic Rosalie Goes Shopping, again, an interesting glorification of the shift now from the society of scarcity to abundance, Because now we see that everybody is looking, they're more concerned about the commercials than the content on television because they're managing their consumptive behavior with their access to credit cards. With the sub-theme being most important here under deregulation, that when you're $100,000 in debt, it's your problem. When you're $1 million in debt, it's the bank's problem. The Applegates became a real intriguing movie for me because this was supposed to be the prototypical middle-class American family in 1991, and all you see are the stereotypes of the bored housewife getting into credit card debt, kids getting in trouble, using credit cards in an indiscriminate fashion. The reality of it is, 1991, we were going through a very serious end of a recession. Structural economic reform. Millions of people a year were losing their jobs in blue-collar industries. There were major gut-wrenching issues emerging in American society, and yet the popular culture was essentially saying that people that were in credit card debt were people that were incapable of curbing their consumptive urges. The profitability and the marketing of the credit card, I tried to look at, we even have a scene in the movie where a family, not only did their dog get a credit card, but Guinness still gets his credit card applications even though he's been dead for a year. But, you know, it is true because of reasons that I'll explain why the credit card industry is so profitable that dogs, cats, and Chairman Greenspan said even goldfish now are qualifying for credit cards in one of his last congressional testimonies. And when I was doing my research in Europe, I said, well, gee, if this is a global phenomenon of deregulation of retail banking, I wonder if it's happening in other parts of the world too. And sure enough, in England, they had a dog that got a 10,000 pound limit. So it just goes to show you how aggressive the marketing is occurring in other parts of the world, which raises the question of what kind of games do we have our children play. This is a state-of-the-art mall madness game, came out in 1989, and see the Easy Credit credit card. Have anyone seen this game before? It's oriented towards young teenage girls. And what are the rules of the game? Is there any long-term planning or foresight? No, it's whoever buys the most stuff and gets back to the parking lot in time wins. How do you buy more stuff? Now, when you go to a sale and you run to the other side of the mall, do you go and you just buy stuff cheaper? No. It just means you can buy more stuff when it's on sale. And it means when you've run out of money, then you rush back to the ATM machine. And you don't ask mom and dad to do extra chores. It's just a random algorithm of how much money you're going to get. So complete cognitive disconnect we're teaching young children today in terms of their relationship to money and what they should be using it for. Well, the credit card industry has given me a lot of criticism when I was focusing a lot of my work on the race to the bottom from marketing to college students to high school students. And they said, look, get off our back because, you know, kids get marketed from the age of 2 or 3. So I said, well, gee, if that's true, it should be reflected in children's games, right? And so sure enough, I went to find the Barbie cash register, and it's marketed for children 2 years and older. This is actually the cool credit card flashlight for young girls that are a little older for Barbie, getting them the sense that having a credit card is normal and completely disconnected from its responsibility. And I know many of you feel like you're your kid's ATM, right? Well, you can actually pay for being the ATM in multiple ways here. And you could say that it's a good way of having kids count money. On the other hand, there's still, again, the disconnect about what's the relationship between getting money and being able to pay for things. This is the Beanie Baby. Again, an effort that I saw of marshaling the major multi-billion-dollar marketing campaign of the credit card industry, of how you make something that's so bad and negative at a personal level, like consumer debt, more palatable and a positive. So you associate it with important iconic images, institutions. Here, the Beanie Baby fad came through, and this was the MB&A MasterCard Beanie Baby, where you shop and shop, and there's so much to do, so little time, you're never through. MasterCard will save the day because it's the easy way to pay, actually to buy, because you're not paying anything. So then I was looking, well, what about boys? How do we get young boys to feel comfortable about credit cards? We're marketing young girls. And this was a 1994 baseball card set that was oriented towards young boys. Now, for those who have young children, this is probably the most loathsome advertising campaign you can imagine. I can't tell you how many kids I've heard parents say their kids are harassing them constantly. Mommy, Daddy, let's go buy some stuff so we can get that free trip to Disney World. So what I really wanted to do in terms of wrapping this section up and understanding about whether we're talking about life cycle changes, generational changes, or historical changes is to see, is there really a big difference that's emerging generationally over time, or is it just simply a life cycle change? And most of the data will show us, even today, with the early baby boomers, people in their 60s and 70s report that they're more than twice as likely to want to pay off their credit card debts than younger people. And that there is a very strong emphasis in the interviews I've done with people in their late 60s to 80s that the social stigma of debt really does have an influence on their behavior. This is one of the other mass marketing campaigns, Case Western credit card, in this case, my Duke card, encouraging people to use the credit card as an extension of your personality. Nobody knows that you're an alum of Case Western unless you actually whip out the credit card and use it, right? So this is what I call the just do it consumptionism, of the rebelliousness of new school attitudes towards consumption. Just do it is the mantra of this generation, and you see it reflected in some of the edgy marketing about credit cards to young people. Again, now that credit cards become an extension of the persona, it's not just a rigid hierarchy of green, gold, platinum, ultimately to black cards, but now it can actually be a personalized image that you can identify with other people. And I always wondered about this one. If you note here, you got 2 free tickets and 1 medium popcorn and 2 small drinks. And given the fact that the average cost of acquisition is about $150, I figured they could at least spring for a large popcorn. But that shows you about how cheap this target population is. New school values of debt, we see constant glorification of basically tearing up the mall. Forget about your parents' attitudes of frugality and conservative values and long-term planning. Actually, the president then reinforced those attitudes after 9/11 and said that the biggest problem in American society in 2001, 2002, in terms of the economy, was too many people were sitting in the living room watching CNN instead of doing their patriotic duty and going to the mall and shopping. And so sure enough, that's what we see then with a whole new form of mass marketing, that it's our patriotic duty to go shopping, whether we can afford it or not. And this leads us to this huge now central question about just like bankruptcy rates that soared in the 90s during the longest economic expansion in American history, counterintuitive and historically unprecedented, we now have 2 consecutive years of a negative savings rate, equally unprecedented during a period of economic expansion, in fact the only time since the Great Depression. This year, the estimated negative savings rate is 1%. And let me tell you how we got to that. At the end of 1998, does anyone remember it was a big deal when we hit 0? Because once you cross the line, it's no big deal after that. And I was invited to go on the Nightline, and everyone said, what are we going to do? We're a nation as a country, and we had the big debate on Nightline. And the federal government's response was, well, let's just redefine the savings rate and include some more asset formation information. And so basically then they raised it by about 3/4 of a point with the new definition. That's how we kept it out of being negative for a few more years. Now we just cannot defy that reality. Right? We're definitely not a nation of savers anymore. Which then brings us to the issue of deregulation of banking and what really has happened that's prevented credit cards being so profitable. These are my 2 credit cards. One, working. Yes, it's used. But it doesn't matter. Credit cards, whether you want to make money, that's the key to the industry. Whatever will trigger for you an impulse to spend, in a nationalistic manner, a selfish manner, or an altruistic manner. And then I'll show you what I think is one of the most astounding advertisements that emerged in 2000. Now, this is a cover of, for those of you who remember, Life magazine. This is 1970. In 1970, there was so little credit card debt, it wasn't even being discussed, under about $25 billion. And yet, Bank AmeriCard, which is a precursor to Visa and MasterCard, already the banking industry recognized the future of its economic success rested on the transition to expanding retail banking. And the only way it could do that was to break down the regulatory barriers that were established during the Great Depression. So this is pretty astounding. This is 1970, and we really didn't see major events happening for another decade. Just to give you a sense of where a lot of your money does go, the top 10 credit card issuing banks last year spent over $2 billion on marketing their credit cards. Anyone have a guess how many mass solicitations went out in the mail last year? 6 billion. That's just mass solicitations. Which leads me to, I just got to indulge me with this one, because this, I would argue, could not have been done, this campaign. Oh no, tell me we can't do it. This could not have been done a generation earlier. This is for the 2000 Olympics.
In a world of sometime over-commercialization and endless official sponsorship, it's nice to sit back and take a moment to simply marvel at the inherent beauty of Olympic sport. The only card accepted at the Olympic Games of the new millennium.
Imagine by 2000, the industry was so comfortable with marketing what used to be a social stigma, essentially marketing cancer, that they could do a self-parody of itself and feel comfortable about doing it. This isn't a typical advertisement about this transitionary point. How many people remember getting a toaster, opening up a bank account? Well, in this case, the toaster was to cement consumer loyalty, that Visa card, because they weren't making any money. It's hard to believe today, but between 1979 and 81, Citibank lost almost $500 million in its credit card division. So three key issues emerged in the early 1980s in terms of the outcome of banking deregulation. One is concentration, a vast accelerant in terms of mergers and acquisitions. I would argue that the cash flow generated from the credit card portfolios, particularly with the rise in the interest rate spread that emerges after the Marquette decision in '78, when Citibank moves to Sioux Falls, South Dakota, and of course later on with the Smiley decision in '96, which lifts all caps on fees. This cash flow is helping to accelerate the blue book value of banks, and so we're essentially seeing a gold rush here of banks that are consolidating. And it's astounding the pace of that consolidation. In 1977, about 50 banks controlled half of the credit card market. Today, the top 10 banks control approximately 90% of the market in terms of portfolio asset value. And the top 3 banks today will control about 60% of the market. So you can have a better sense then about how they work in lockstep together in terms of their policies. This is an example of consolidation. These are the AT&T credit card was the 8th largest credit card issuing company. These 3 companies are all owned by Citibank. You hear a lot about that this is the most competitive industry in America. You got to say, well, which is it? Is it a monopoly? Is it a competitive with 6,000 issuers? Well, actually, those 6,000 issuers are just owned by a very few number of banks. You may have your local bank with its name on it, but it may be owned by Citibank or Chase. The Home Depot credit card, for example, is owned by Citibank. The second key feature is the conglomerate structure of banking that emerges, where technically Travelers Group purchases Citibank, which is the ultimate irony since Citibank then essentially jettisoned Travelers Group a couple of years ago because of the difference in terms of their profit growth. That, of course, was a key loophole that led to the illegal merger that Congress permitted in 1998. The key issue about the conglomerate structure, particularly about those interested in the community reinvestment bank issues and in terms of lending to disadvantaged groups, is that what we're seeing here is the pressure for cross-marketing, which is used to essentially pay for the inflated values that were paid for these acquisitions. That cross-marketing becomes the underlying assumption in terms of the cost associated with the consolidation. And this is where now a consumer is going to have to finance these transactions by purchasing a larger bundle of services. So the traditional retail bank that used to offer just an auto loan and a mortgage and checking and savings account, now under this new structure, they're going to be sold insurance products, be sold investment products, annuities, etc. What does this mean in terms of minority communities? Well, this means that we're going to see an overabundance of branch banking and investment and marketing in affluent neighborhoods where the average consumer can buy, say, a dozen products or services. Contrast and juxtapose it to minority and disadvantaged communities where they're only going to be able to afford basic financial banking services. It makes sense to understand in the logic that the closing of these branch banks are a necessary cost benefit in terms of the larger process that they see unfolding under deregulation, particularly the emphasis on high tech and online banking, which then further reinforces this divide in terms of financial service access. The third point then being the bifurcation of the banking system, the emergence of fringe banking. I would argue today that the huge, robust increase in housing appreciation has been underwriting both the lower delinquency rates of higher risk subprime loans, but also things like credit cards. And we're going to see this kind of precarious connection about now with deregulation, you can pay off your credit cards by refinancing your home. And it just makes no sense anymore that you're paying off one debt with another debt, but it does in terms of tax code as well as interest rate costs. So those three basic issues have had profound implications, particularly because, as we'll see, the promise of deregulation was to offer more services at a much lower cost. The reality of it is that deregulation actually yielded a cost structure that really reflected the increase of inequality in American society. What I've referred to with credit cards is the moral divide. What other lending relationship can you think of where the most affluent groups get a free loan and the most disadvantaged groups have to pay for everybody else? Now, as credit cards became more and more profitable and the driving force of consolidation, a really interesting thing happened. By the time we get to the 89-90 recession, you'll see here that the percentage of credit cards in relation to installment loans is fairly low, only a fifth. But what the banks realized is that consumers were so reliant now on credit cards to survive that they were actually spending more money on their credit cards to survive and not defaulting and going delinquent. And they realized, particularly with what's going on with globalization and the restructuring of blue-collar industries, that workers will pay whatever it takes. Their elasticity of demand is really low. They're willing to pay high prices because the credit card is becoming their social safety net. So in 89-91 is the first recession that we actually see credit card debt is increasing, that the banks, instead of tightening up credit, actually offered it more generously because of the rate spread that they were getting. This is the growth of credit card debt, and this is an interesting conundrum that I constantly get questions about. People are saying, well, gee, credit card debt's flattened off over the last 3 or 4 years. That must mean Americans are more responsible with their debt. Well, not in the context of deregulation, because as I was doing the numbers for my testimony, I realized that if you looked at the growth rate of credit cards and compared it to the growth rate of installment lending 5 years before the recession and 5 years after the recession, the growth rate for installment lending didn't change at all. Actually, it went up a little bit. But the growth rate for credit cards went from about 9.5% a year to 1.5%. And so it's very clear that this difference was because people were paying off their credit cards with their home mortgages and home equity loans. So I would argue, when you see the numbers, you will see both the government that consciously underestimates and misreports the amount of consumer debt will say, you'll see the number, the average household in credit card debt is $9,300, but that includes the 40% of households that don't have any debt. If you only look at the households with debt, it's about $13,000. And then you factor in my estimate about what people paid off in the last 5 years with their home equity loans, it would be over $19,000 just into credit card debt. And so what we're going to see here is the fluidity that's being created here. And particularly at the end, I want to raise what I think is going to be the most disturbing issue, and that's the emergence of the creation of these conduit loan structures by global banks that are simply trying to structure stable investment products that are shifting the risk from the originator of the loan to the investors, but they're only concerned about satisfying investors, not consumers. And so the result is banks, to minimize their risk, are become fee-based through originations. They're making their money on you signing up for your loan, packaging your mortgage into an asset-backed security, and then making a second fee on the resale of that security and the premium that it's going to be paid. What does this mean in the long term when your mortgage is a $100 million tranche of debt is being purchased by a Japanese insurance company that doesn't care whether you got laid off and you got your job back and you want to get caught up on your mortgage payments? It raises a whole set of issues cognitively and culturally about who's financially responsible. The deadbeat in American society was viewed as the person who couldn't pay their debts. In the banking industry, the deadbeat is the person who can pay his debt. And a lot of people say, well, that can't be true. You make money on them, right? Well, no, you don't. Because actually what you do is, I basically decompose the cost of these loyalty reward programs, and when you factor in the fact that the cost of funds has gone up from 1% to 5.5% in the last 5 years, and the cost of these loyalty reward programs, and with the feat in their collusionary policies with the merchant fee, so in other words, their percentage is going down, they're actually losing money on, unless you're a really big charger. So that raises this issue here about the whole question, well, deregulation had to be a big benefit, because look at the elevated standard of living. And what I did then is said, well, let's take a look. Let's graph the net cost after the inflation, which is factored in the federal fund rate. Let's just look at the difference between what they charge you and what their cost of funds is. And sure enough, if you look in the early 80s with deregulation, and of course inflation is going down, what happens is the cost of borrowing with credit cards is soaring. The cost of borrowing for corporations in the corporate rate is only going up modestly. And of course the fluctuations in borrowing for owning a car is being manipulated depending upon the business cycle. But bottom line is, I would argue when we factor in fees, the real cost of borrowing, if you're in debt with your credit cards, has tripled during the period of deregulation. I just updated this before I came to look at the last few years, and you can still see what's intriguing is that when the federal fund rate went to 1%, the credit card industry didn't pass on that savings to their consumers. Just like when they said, if we tighten up the bankruptcy laws, right, we're going to pass on those savings to consumers. We're not seeing lower interest rates either way. Of course, the reason is that with federal preemption, only Congress can regulate nationally chartered banks, and there's only one bank that actually has an interest rate cap, and that's Bank of America at a mere 36%. And so what I wanted to do is just real briefly show you, well, where is the money coming from? Show me the money. Well, here's a couple of really interesting things that are happening. You look here and you see penalty fees and cash advance fees total about $13 billion last year. And it cost the industry virtually nothing. But late fees actually went down. How do we explain that? And I would say it shows you the gap between the rich and the poor in America, that late fees declined because people who had equity in their homes were paying off their credit cards. Cash advance fees were going up because the most disadvantaged in society were relying more and more on their credit cards to pay for basic expenses. Interestingly, this is the last year when, before the new bankruptcy laws come into place, and the charge-offs on consumer credit card debt were actually declining before the bankruptcy law was enacted. So again, facts are irrelevant in terms of this particular debate, and the bottom line is between 204 and 205, when the industry was clamoring for a regulatory response in terms of squeezing consumers, they had a record increase in profitability of over 30%. Really raising questions. I got this call from one of the trade magazines, and they said, we're doing a story about why people don't like their credit card banks. And I said, boy, now that's a real tricky question, isn't it? You know? And of course, there's the Cleveland connection with Alfred Lerner. That's how he bought the Browns. And Charles Colley was one of President Bush's pioneers. In fact, when the dispute over the inaugural festivities occurred, there were two corporate funders for President Bush, and it was Enron and MBNA. What's striking, and don't have time for this, but this bottom line is the U.S. is beginning to reach its saturation point, and this has a very scary implications because the global banks realize that their future growth is outside of the United States, not inside the United States, and that's why they're working so hard for global deregulation. This is a chart, and I know many of you can't see it, but let me just give you the gist here. The most aggressive marketing of credit cards globally is where we see the sharpest decline in the national savings rates. And countries like Germany, which have sought very hard to maintain their social welfare policies and programs, we see strong resistance to credit cards. National savings rate has remained pretty constant. Looking at countries like Germany, like the United Kingdom, even Italy, we're seeing that their savings rates have dropped by half and even more. So this is going to be a huge impact on us in the future in capital markets because who's going to save and lend us the money? It can mean interest rates can only go up on a society that is so heavily in debt that a mere percentage point can make a difference in the robustness of a housing market. Bottom line is, I'm sorry this comes out fuzzy, I wanted to look at asset formation compared to debt formation among the middle class. And what I'm going to show you real briefly here is how the last 10 years was supposed to be such robust prosperity. The bottom line is the value of assets rose and fell. Equities rose and fell in the late 90s, early 2000s. Now we're going to see the same thing with asset formation. What's most important is that in the last 5 years, debt has far outstripped the accumulation of wealth. And I think that after the housing correction, it will erase the net wealth that was accumulated for probably 40 to 50% of Americans. Are we addicted to spending? What is the argument? How does public policy account for this? Is it a cognitive change? Is it a cultural change? Is it people incapable now that no longer do you have your local banker call you up and say, yeah, you can qualify for the Buick, but we think we're stretching you and we're only going to let you have a loan for a Ford. Can you imagine that conversation happening anymore? Consumers are being perceived as essentially they need to be defended against their own self-interest. I did this talk at a compulsive gambling conference and I came up with this very interesting comparison for you sports fans. It was Charles Barkley who said he lost $2 million gambling. And then there was John Daly, the golfer, who says he thinks he lost somewhere between $10 and $15 million, but he's not sure. And Charles Barkley said, I don't know about that, boy. He says, because that's a lot of money, and I think you'd know whether it was $5 million, give or take. He said, I worked. I know exactly how much money I lost gambling. John Daly only took it on credit. He has no idea. If he wins a golf tournament, they give him $1 million line of credit, and he doesn't know until they say you've run out. And that's, I think, symptomatic of what we're seeing in terms of this market-based guidance of underwriting standards for Americans. The key issue here, again, the financial laws of gravity were defied over the last 5 years. No other time in American history can you think of that real income declined and yet metropolitan housing prices doubled. In fact, ironically, income is starting to bump up a bit now as housing prices are going down. It shows you what a critical role that access to credit and the price of credit has played now in terms of macroeconomic policy, but also the decisions of consumers to invest in certain areas. This is just to show, particularly with globalization, that young people have suffered especially hard. They're beginning their careers with a lot of debt, and yet their real income fell the sharpest. the competing perspective, Liz Warren at Harvard Law School is talking about, no, it's not overconsumption. It's that life has gotten more expensive, more insecure. There are more unexpected events that become costly. And here's where the two issues of deregulation and I think the two income traps start to come together and kind of dovetail with whether it's indolent consumption and overspending. What's striking is in just 10 years, when we look at the fact that discretionary income, Americans are spending about 30% more on average than their discretionary income. We see most of it is associated with housing. That's 62% to 95% in that 10-year period allocated to housing. But the reality of it is it's not really housing debt. It's all these other debts that Americans now are limping through. And as soon as there's a decline in the interest rate, they're financing all their other debt into their housing debt. And so what happens, and here's going to be the real crisis with the housing market and the bankruptcy court, Americans go and they pay their mortgage bill. All of a sudden they get a reset in their adjustable rate mortgage. Their mortgage goes from $1,200 to $1,500. They're barely making it, and the excess that they can't afford to pay goes on their credit cards. Suddenly now they accumulate more credit card debt. And now that's going to trigger a risk-based assessment that's going to double or quadruple their interest rates. Suddenly it's not the amount of debt they're in. It's not whether they've lost their job. It's the fact that the banks can literally play God with the interest rates and minimum payments about whether they can make their mortgage payment or not. And so what we're seeing now across the country is the rise of people filing for bankruptcy who've never been late on their mortgage before. Unprecedented to see it at that level. And it's because it's so easy now to refinance through all these different levels. Living with debt used to mean managing credit prudently. And in fact, this again underscores the pressure on the American middle class. The rise in delinquency of bills, the biggest increase is the doubling of the 20% of the middle. It is about bills. And similarly, the growth of household debt service is focusing on the middle class. The biggest jump is right here, the middle 20%. And this is the chart that I put together to try to show how profound the change has been, not just in the aggregate level of debt, doubling in just 10 years, but the fact that it seems to be concentrating more and more into mortgage debt. Well, what happens to mortgage debt? Almost 70% of all mortgages are repackaged and sold as securitized securities that are asset-backed and resold in the secondary market, which means more and more people, if they stumble and think that they're going to go back to their local bank and get caught up on their loans, are going to find out that the institutional investor has already priced in a 1.5% loss and doesn't even care, is not going to hire staff or lawyers or anyone else to work with people. And it's what I'm calling the consumer blind spot, because in many cases, and in a case right now, the investor just doesn't want to be bothered. It's just easier for them to liquidate the property and move on. So this raises a whole series of questions about who is the worthy debtor. It is unquestioned that the marketing of credit cards, particularly high interest rate credit cards, has led to debt burdens that have pushed people to the edge. That as long as the unexpected doesn't happen, they can pay the minimum payments and it's not a problem. It's when the unexpected happens, they don't have a reserve for the proverbial rainy day, that we see then this surge in bankruptcy when we've had this period of economic prosperity. So what I want to conclude then is, this is the credit card to me that the story in the comics that epitomized the marketing of credit cards. Originally, the higher status people had the highest lines of credit and therefore were most desirable by risk-averse bankers who saw their best customers were people who could pay their loans. Under deregulation, the best customer now is somebody who can't pay their loans. And more importantly, in the past, you got rewarded when you paid off your loan by getting new lines of credit and new loans. Today, you get rewarded by not paying off your loans by getting more levels of debt. And I think this is going to have huge implications in terms of what I see as the new generation of bankruptcy filers. I think that we saw the last 5 years, homeownership kept people out of bankruptcy. I think now we're going to see in the next 2-3 years, homeownership is going to push people into bankruptcy. to the point that deregulation and democratization of credit, this is one of the key marketing ads that led Jay Leno to say that the Kmart Gold Card, the slogan should be, "Don't leave your trailer park without it." Are people prepared and going to prudently use their consumer credit? For college students, right? You saturate the traditional market, the middle class people who have the wherewithal to pay. You've got two choices. You go after more marginal clients, and you go back to your existing clients who could pay and manage their debt, and you double their debt loads. And now what we're seeing is the most prized category are college students and now high school students, because you can shape their attitudes towards credit. They don't have debt. For parents, this is my Hall of Shame credit card. Preying upon parental authority relationships, but also very duplicitous for young people who don't know the difference. Get 3% cash back on everything you buy if you carry a balance. So if you're actually prudent, there was a negative incentive. You don't get any cash back if you actually pay off your bill in full. I find that kind of deceptive. We don't have time, but Bart Simpson did get his credit card. There are good credit cards. This is the Chase card, where your 1% goes into an annuity fund. You can actually get invested in a mutual fund. One of the capstones of my career was the comic strip Zits. Did a whole week on my credit cards on campus report. And the one I don't have is my favorite, and it's where Zit's parents are talking for breakfast, and Dad goes, "I feel a disturbance in the force." And you go back to the bedroom, and there's Zitz reading his pre-approved Gold American Express card. Students easily impressed, right? Mass marketing from Capital One. Cash, who needs it in this rebellious era, particularly with electronic transactions. Part of the popular culture now. We're going back to an assumption that debt is an inevitability. Why fight it? Accept it. It's going to be with you till retirement. On top of that, democratization has meant expanding the frontiers for people who are less creditworthy and creditworthy. And what I see as one of the worst marketing strategies is when the big tier banks, and I was in one class action suit against Capital One, the no-hassle card that has a traditional card, but then has a subprime card where you get a maximum of $300, but you have to pay $220 in fees before you can activate the account. How do you know if you've gone through a period of distress and you've had the regular Capital One card? You don't know that they marketed you strictly on your credit score. This is the Diamond credit card where the interest rate is 35%, playing upon people's ideas, right? Diamonds are better than gold, so it must be a better interest rate. This is an example of negative amortization in credit cards where the minimum payment is less than the interest rate accrued. Where consumers' dependence on credit now is when the payments stop. This is a credit card for $39,000 with a $15 minimum payment. And they're saying, that consumers are out of control. They set those terms. Providian Bank, some of the marketing for the most disadvantaged people have 0% interest rates, and they're the only major bank that got hit with a $300 fine. You will not find a Visa or MasterCard or member bank that has been punished by the Association for Egregious Marketing Practices. 0% becomes kind of a marker that you think this is a good card. The reality of it is this industry gets about 70 to 75% of its revenues are fee-based and has the most egregious debt collection policies. The stories I can tell you are just unbelievable, and they simply see these state-by-state litigation as the cost of doing business. We did at least win something here. 12 months, same as cash? No, right? Because it's retroactive interest. That's why there's the asterisk. It's not the same as cash. $1 after those 2 years, all that interest is retroactive. This simply to show you that the industry has gone after the most extreme components of marketing in terms of the young, the old, and the most financially vulnerable. And it's less and less important to them because they repackage this debt and resell it as securitized products in the secondary and international markets. Another Hall of Shame card. This is a subprime credit card. Look at this. Education is the answer. You get a maximum of $250 I'm sorry, $300. There were $269 in fees. This $300 credit card. First Premier, a big deal was made of one of its founders, Mr. Sanford, last week. He gave away $400 million to his local hospitals. And how did he make his money? He was gouging his most disadvantaged citizens with $250 lines of credit, but only $30 of credit were actually available. These are credit cards, gold cards, with 0% interest rates. With 0 grace periods. The interest rate starts immediately. And one of the big issues that I'm addressing right now is Walmart's effort to become the global bank. And they have bought a bank in Mexico. They, as many of you know, they tried to get an industrial bank in Utah. Interesting, Target is the 10th largest credit card issuer. They have the industrial bank in Utah. Congress did say, no, this would be too big of a problem. All kinds of variants for the most disadvantaged. These are cards that are basically worthless. They just get you to sign up for fees, but the products you can buy are their own, and you really can't buy anything. So the end product then is, for the most disadvantaged, we've seen now the emergence of the third tier, where Ace is not a hardware store, where interest rates, I have this one real quick example. Of course, John Madden now giving credibility to this industry, trying to show my field work about the cost of the credit, how they consciously screen out people with the financial wherewithal to pay in cash. But this was an actual contract where you lease cash. And it's a secure contract. You have to have 3 forms of electronic equipment: a computer, a television, and a stereo. And it's 30% interest for 15 days. And when I did the field work, what I found was that this was really heavily indebted, aspiring middle-class minorities, which leads then to the conclusion. Where are we? And what's on the horizon? And I think the real key issue is going to be, we didn't expect Congress to have such a profound shift. We did have hearings a couple of weeks ago, but what is the impact that it's going to have? And let me just say where I think we're going to go on that. In terms of where we're going to be with regulatory responses, oh gosh, it's not showing. I'm sorry. Barney Frank is the chairman of House Financial Services. He's more of a politician than you might expect. He has not been a particularly strong advocate of consumer rights and retail banking, and he hasn't been a particularly strong advocate of deregulation in terms of re-regulating some of these policies. I think what we're seeing here is the committee was addressing issues of, are they going to address federal preemption? No. Clearly they're not going to address issues. We're just talking about a soft usury rate cap versus a hard rate cap. I don't think it's going to happen. I've actually gotten involved with a very interesting suit that's attacking the Smiley decision about whether late and over limit fees are punitive, and how a recent Supreme Court decision offers some creative responses to that. But keep in mind, with federal preemption, you only need 35 members of Congress to defeat any pro-consumer legislation from going out of committee before it ever hits a floor vote. And then that means it's never even going to get to the Senate. And what you find out is, when you study who's on these committees, you find out that both parties put some of their weakest members on the banking committee. Why? Because they can have a pulse and get enough money through their financial service PACs to get reelected. I mean, to my shock, one time I testified, and there's Catherine Harris. Not exactly the brightest light bulb in the house. But she was there because she was going to get enough money to get reelected. The OCC has made a bit of a shift in terms of its rent-a-charter issue about banks that, from states without interest rate caps, where partnerships with payday loans were basically used as a subterfuge to have unlimited payday loans and no caps. The OCC is starting to clamp down on that, but we've actually seen some of these banks then reject their national charter and then go ahead and recharter as states, and then continue the same kind of practices. The last thing I just want to mention is that in terms of bankruptcy and what I've seen happening is that the banks now essentially control the credit counseling system. They have the IRS decisions of closing down many consumer credit counseling groups has been that they've simply been agents of creditors rather than serving in the best interests of consumers. So for the first line of defense, debt management is not what it used to be 20 years ago. That we're seeing the rise of housing appreciation pushing more people to consolidate their debts where they should be looking for some form of debt relief. So it's raised the debt burden, pushing them into a credit counseling system that only 1 out of 4, 1 out of 5 people survive. Clearly, that's not a very good future for those groups. We're looking at binding arbitration. I'm astounded in subprime credit cards with Capital One. If you actually won in binding arbitration with this card, you were required to go a second time and pay for it. So it really raises the issue now in terms of tort reform about what kinds of cases now are going to be viable in terms of these specific kinds of retail banking issues. I've seen especially the attack on private debt negotiation as an option. I worked with the state of Utah, and they actually passed a law that would offer a lawyer-supervised 3-year repayment program as an alternative to people who were eligible for bankruptcy. And Utah was the #1 bankruptcy state in the nation. And I've met with the major credit card collection agencies, and every single major bank said that this multi-lender approach is the only way to help address the problem. But I think it's the biggest trend, and that's the rise of the highly indebted people in the middle. They can't pay off all their debts through a reorganization, Chapter 13, but they could pay some of their debts, and they don't want to go through a Chapter 7 liquidation. The banks would rather continue their adversarial approach, batter consumers into submission, force them to liquidate their assets, go and even lose their homes, and get 10 or 15% pay, rather than to go into what would be in their best financial interest. So it shows us then that there's not going to be any hope without a legislative response from Congress. Will the U.S. Senate assert itself? I think there's only 5 issues that they suggest that they would consider, and that's going to be disclosure. There's a consensus that disclosure policies are inadequate. And remember, federal preemption case law has been used not only in terms of pricing cost of financial services, but also disclosure issues as well. Identity fraud and consumer privacy, clearly out of control, and Congress knows they have to do something. Predatory lending and subprime, such as subprime credit cards, they know there's a consensus that this industry is just not defensible, so it's going to be an easy way to demonstrate that they're going to stand up for consumers on some of those issues. Marketing to college students, the only reason there's bipartisan support is both Republican and Democratic members of Congress have kids that are in credit card debt problems. They said it in the hearing. And the final key issue, and what I think is going to be most important that very few people are talking about, is the impact of securitization of things like automobile loans, credit card debt, mortgage asset-backed securities, where the whole structure of these conduit loan programs are designed to get property loans off the books on major global banks, get them in the hands of investors who are going to opt for them over treasury notes, price in a certain default rate, and as long as the robust housing market kept those default rates low, they really didn't care. And what scares me is, as I think when we see the correction in the housing market, many of these major institutional investors are going to start panicking. They're going to immediately force foreclosure and liquidation on a lot of people that could get caught back up on their loans, but there's really no way to force them to service these loans and help them get caught back up. And so I've seen very clear cases where these companies are willing to take a loss rather than to hire the staff to really manage these properties effectively because they thought it was a passive investment. They wouldn't have to worry about it. Now we're going to see more and more of these problems emerging simply because the financial service market has become more sophisticated in how they've marketed and repackaged the debt. The consumers don't have a clue about how serious their debt problem is, which leaves then, from the industry's point of view, it's your life, and you're the one who has to choose how to spend it, and if you make a mistake, it was simply the devil made you do it. So I'm sorry I went over your time.
Cultural transformation and all the shenanigans that have come in as a result of that, mainly headquartered in the United States, sort of mostly. It's spreading globally. But recently, Japan apparently reacted and began to cut back on, or at least limit consumer finance, causing Citigroup, I think, to take a hit. Is there something going on in Japan that we should be keeping an eye on?
I was in Japan, and there's a real interesting debate. They say that there's a generational problem, that young people, before they get married, they just basically blow every penny they make. And then as soon as they hit 30 and get married, they have to be responsible citizens. And there's a real, and of course a lot of women don't want to get married, so they want to stay home and still be consumers. And so there's a real debate on terms of the sharp decline in the national savings rate in Japan, if basically they're getting the worst of American consumerism, and what would be the appropriate policy response. And I'm not sure which Citibank case you're talking about. When they were doing the money laundering is when they got kicked out of Japan. But there's some other issues with the finance instruments that they're offering that, given the regulatory structure of Japan, they're much more circumspect about what kind of products they allow out there.
And apparently they cut back. In other words, they said no more 30% anything.
Mm-hmm.
Okay? And Citigroup is going, oh my God, we just dumped into this big time, and now we can't get what we thought. So that's, I mean, it was a change nationally in what they were going to allow.
Well, there's a huge fear, because keep in mind, if you were to compare any country in the world and you said there's job insecurity, there's falling real wages, healthcare costs are soaring, pension funds are underfunded, housing prices, education, everything is going through the roof. Any other country in the world, you would see a bump up in the national savings rate. Only in the United States do you see the response going deeper into debt. And so a lot of countries are looking at the U.S. example and saying, my goodness, if we let Citibank do that here and that's the outcome, we need to take a step back. But keep in mind, these are very different regulatory structures about how they offer guidance with these banks.
What's the status or the effect of credit card insurance these days?
The enhancements that they offer, the emergency
I
crisis.
seem to recall that in every solicitation there's also some ability to sign up for some sort of insurance against the
Well, and it's an interesting point you raised, because technically it's not insurance, because then it would have to be reviewed by the state insurance commissioners in terms of the premiums versus the payouts. And they're basically, you can't justify the premium for what the value is of what you get. So most people, even if they claim, you only have like anywhere from 6 to 2 years that you can claim it, but you still have to pay the premiums during that period of time. It's an incredible waste of money, and the sad part is it's usually the most disadvantaged people that sign up for it.
Excuse me. I think we need to bring things to a formal conclusion. I want to thank Professor Manning. I'm Jonathan Enton. I'm the Associate Dean, and unfortunately Gary was not feeling well and had to leave and asked me if I would wrap things up. And thank you for a terrific talk. We will have a reception out behind the moot courtroom in the lower rotunda, and I encourage you to continue the conversation with Professor Manning there. But thank you very much.